Hey guys, welcome back to the channel. It's Pete. This is where we talk about money, finances, where we give you information and education to help you make the best financial decisions possible. So, I'm going to talk about negative interest rates today, and I know that isn't sexy, it's not particularly attractive, but it has been in the news this week. People are asking questions on IG, and there's been a few comments on here on YouTube, and it is something that is likely to be more and more and more of a possibility. So, with that being said, I always want to make sure that I'm using my knowledge and my expertise to enrich you guys, to help you guys make the right decisions. So, it's right that we cover this topic. I promise I'm going to try and make this as interesting as possible and keep it as simple as possible. So, bear with me and let's get going. Okay, so I think it's really important for us to get the basics in place. So the Bank of England essentially sets all of the interest rates that the banks charge to consumers, so to you and I. And they meet every single month in something called the Monetary Policy Committee. And they decide whether they increase, reduce the bank rate that governs how much banks charge their customers, so you and I. Now, the bank rate has been low for a very, very long time. In fact, since 2007, 2008. And in actually preparing for this video, I thought I'd have a look at what the interest rates were back in 2005, just to draw the parallel of where we were back then and where we are right now. So back in 2004, there was this article that was written in December 29th. And they were speculating that the UK interest rates were likely to go up by another 0.25%, pushing the interest rate up to 5%. 5%. That was in 2005. Compared to where we are today, the bank rate is at 0.1%. So we are miles and miles and miles off where we were back in 2005. And for good reason. We had a financial crash in 2007, 2008, and the recovery from that has meant that the Bank of England has decided to keep those interest rates low in the interest of the economy. Now, we've never been in this territory before. I mean, the conversation of negative interest rates, you wouldn't have thought it. However, with everything we've been through this year with COVID, and we potentially got Brexit, a no-deal Brexit to deal with come December this year, these are levers, tools that the Bank of England are trying to use to stimulate the economy. And I'll explain very, very briefly how that is so. So if the bank rate that the Bank of England sets for banks to lend money to individuals, to consumers, is set to negative, it's going to do a couple of things. First and foremost, it's going to encourage people to borrow money, because that's a good thing. Borrowing money means that money is given, it goes into the economy, and that could be for house purchases, so on and so forth. And that is a good thing because it means that money can actually circulate. What it also does, it means that if you have money saved in an account, saving money in an account becomes less and less attractive, which means that it may encourage people to spend money. I'm going to talk a little bit about these a bit later on, but it's, the idea of negative interest rates is designed as a tool, as a lever that the bank can use to help stimulate the economy. Now, the big question is, if there are negative interest rates introduced in the country in, say, 3 weeks' time, what impact does it have on your money? So I'm going to tackle this from three angles. First and foremost, I'm going to look at it from the angle of if you have personal loans, credit cards, those kind of things. I'm also going to look at it from a saver's point of view, and I'm going to look at it from the point of view of if you have a mortgage. What are the things that you need to know? How might it affect you? And I'm going to give you a few things that I think might be worthwhile you considering to make sure that you're getting yourself in the best position possible. So let's start off with, what does it look like if you have personal loans, credit cards, those kind of debt? Now, if you've got credit cards, personal loans, it is very, very unlikely that negative interest rates are going to change how much you're paying for that facility. And for a number of reasons. First and foremost, loans, credit cards are typically unsecured debt. So meaning there isn't an asset that they will take to recuperate their money if you can't pay the debt. Secondly, the risk, you could argue, of them lending money to people right now is actually higher than ever, especially with what we've been through with COVID and the uncertainty around jobs. Potentially because we don't know what's going to happen, whether there's going to be another lockdown through Christmas and through New Year's. So the risk level for lenders is still pretty high. And thirdly, these facilities cost money to administer. So they have to be set up, they have to be ran. There are associated costs with that. So it's very, very unlikely that negative interest rates are going to reduce your debt rate. So your personal loans, your credit cards, so on and so forth. So if you've got a mortgage, or if you are looking to get a new mortgage, there are a couple of things that you need to know. So let's start off with if you already have a mortgage. So if you already have a mortgage, you are likely either going to be in a fixed rate term. If you are, it means that essentially nothing is going to happen to your rate because you have a contract which is fixed for a period of time. So there isn't going to be any benefit by having negative interest rates if you're on a fixed rate mortgage at the moment. Now, if you're on something like a tracker or a variable mortgage, then potentially with a tracker and variable, what you'll find is that your payments will fluctuate. So if the interest rate goes down to negative, you will see that your mortgage payments will reduce alongside that movement of the Bank of England base rate. However, some of the lenders do have written into the contract that your mortgage rate cannot fall below a certain level. They call it a collar. So if you are on a variable sort of like mortgage or a tracker, it's probably worthwhile you looking through your mortgage documents right now just to see whether there are any flaws under which your mortgage interest rate cannot fall below, because that's going to give you a really good idea of what you're likely going to be paying going forward for your mortgage. Now, is this going to be a sustained sort of effort? Nobody knows. Potentially, we've been in a low interest rate environment since 2007, 2008. Although it hasn't been this severe or this low, but we don't know whether this is going to be a sustainable or sustained effort by the Bank of England in trying to stimulate the economy again. So if you're on the market for a new mortgage, then it's really important that you start to pay attention to the mortgage interest rates if negative interest rates do get introduced, because essentially what that means is that you're going to be in a position where you can pick up some really good deals. Now, there is a question to ask to say, well, if there are negative interest rates, does that mean that you're going to get paid to borrow money? Negative interest rates have been used across the world. They've been used in Switzerland, they've been used in Japan, and a number of other places as well. And there is a bank, I think in Netherlands right now, that will actually, it's not paying customers, but because the rate is a negative rate, it means that the mortgage is being reduced automatically every single year by the client doing absolutely nothing. So for example, what this bank is actually doing is saying, well, if you have £100,000 on a mortgage and their rate is minus 0.75, then what you'll see is that your mortgage is going to reduce by £750 every single year. Now, will that happen here in the UK? We don't know. We've never been here before. But certainly if you are looking for a new mortgage right now, you need to start paying attention to the interest rate, pay attention to the news, and make sure that you're hunting around for a good bargain, because potentially there'll be some very, very, very good mortgages out there that will cost very, very little if you're looking for a new. Now, that does lead on to the question of, well, if I've got a fixed rate mortgage, would it be worthwhile with me moving away from a fixed rate into a mortgage with a negative rate or near negative rate? And the answer to that is you need to consider what is going to be best for you. Most fixed rate mortgages will have early redemption charges, so you need to figure out what that is. And you need to figure out if you're actually going to be saving any money long term. And again, we don't know how long the Bank of England is going to use this to stimulate the economy. It may only be negative for a short period of time. So there are lots of considerations when it comes to mortgages. What I would say is you should speak to a qualified mortgage advisor to give you the best advice possible, because they will have a look at your circumstances and recommend the best course of action for you. So if you are saving money and you have money in the bank, this is terrible news for you, because it's already bad enough that you're not getting any interest, in fact, at the moment with banks currently if you've got it on instant access. You'll be very, very lucky if you're getting, 0.5%. You're not getting anywhere near that. I'll be surprised if you are. You may be in a fixed account that is giving you just over 1%, 1.1, for example. But with negative interest rates, this is not a good thing for savers. And again, it comes back to the fact that the Bank of England are trying to use negative interest rates to stimulate the economy. So as a saver, if you have £10,000 in an account, you're not getting any interest on, then you're more likely to redeploy it elsewhere. And there are a couple of ways that you might do that. You might decide to basically make a purchase and buy something so the money goes back into the economy, it's circulating in the economy. That has a positive impact on inflation, which is currently way lower than the 2% target that the Bank of England have set and normally set for inflation. So money going back into the economy could be a very, very good thing. It may actually give you the impetus to start investing in the market and buying an index fund, for example. And we'll talk a little bit more about that a bit later on. But it is essentially being used as a lever to get more money into the economy, either be that by spending or borrowing. Now, if you are a saver, there is this one question that is being asked. Are you likely to have to pay your bank to hold your money? Because potentially that is something that is a real reality. The answer to that is nobody knows. The likelihood of it happening is very, very slim for the average person. I know that there are certain parts of the world where they have introduced, I think in Switzerland, they have introduced a charge for deposits, for money being held in an account. And in Switzerland, the limit is 500,000. If you have over 500,000 or up to 500,000, you pay a set fee. Over that, you pay a set fee as well. Will that be introduced here? We don't know. It's still yet to be seen. I think the danger that you have with introducing fees for savings accounts or current accounts is that people will potentially decide, well, I'm going to take all of my money out of the bank, I'm going to put it in a shoebox, put it in the house. Terrible idea, because if you did that, the house were to burn down or you were to get burgled, you lose everything. So a bank is still a good place to put it and to leave it. But many people will not like the idea of having to pay for that privilege. And again, we don't know what is going to happen. It's very, very unlikely that they will introduce a fee for normal customers with, deposit of say £5,000, £6,000, £10,000, for example, because they wouldn't want to risk the run on the banks and they'll face huge liquidity problems trying to get that money out to people. But certainly for bigger accounts where there might be £100,000, £200,000 in the account, they might introduce fees for that, but that is still yet to be seen. So for savers, it's not a great place. And unfortunately, it is a lever that the Bank of England are trying to pull to try and stimulate the wider economy. You can argue that everything's gone digital now, so is it really going to go into the local economy? I mean, just look at Amazon, for example. They've done extremely well through COVID, and that is particularly important if we were to go into another lockdown over Christmas and New Year's. Where's this money going to be spent? If everything is shut down, it's not going to go into the local economy, it will go into the coffers of Amazon. And that's great if you have Amazon stock, but it's not great for the local economy. So with those three areas covered, I want to kind of wrap this up. What are the things that you can do? Well, now more than ever, I'm going to refer back to the basics that I always talk about here on this channel. Need to understand and make sure that you have a really good control of your finances. And what I mean by that is having a robust budget. Really, really understanding what you've got coming in, going out. And what I'm going to say, guys, is, put some work into this. Sit down with your bank statements, figure out everything that has gone out of your account over the last 6 to 12 months, categorize them into essential and non-essential. And you really want to make sure that you've got a really good handle on those things. And the second thing that I think is important is connected to the first exercise of that budgeting, sitting down with your statement and really going through what you've had coming in and going out of your account, particularly paying attention to things going out of your account. You need to have an emergency fund. And the reason for that is I want you to be really, really clear in terms of what you need in an emergency fund. Because if you are lucky enough to have quite a bit of money lying around in an account, then you will probably want to consider putting it somewhere else. And I'm talking perhaps into something like a fixed rate option right now. You can get 1 year, 2 year fixed rate bonds. that might be an option for you. But you need to understand exactly how much you need in an emergency fund so that if the worst were to happen, you could at least access some cash without breaking the terms. Now, with a fixed rate account, if you were to go and open one, typically they would have penalties for you accessing the money early. So, for example, if you went into 1 year fixed rate account and it was offering you, say, 1.5%, if you wouldn't, under the terms of that account, be able to access it for 12 months. So you have to wait for that period of time. Now, you could break the fixed rate term, but you will pay a penalty. Typically, it used to be 90 days interest. Now, with the interest being so low, you may forfeit the entire interest that you earn on it. So again, it's really important for you to understand, if you have got money lying around, how much you need in an emergency fund so you're not leaving yourself short. And guys, really important, make sure you give yourself room. Make sure you give yourself rope. Don't be too stringent on the financial strings when it comes to this. Yes, you want to have money working for you, but you don't want to put too much away to the point that if you need something, you can't access it. So those are just a few tips from me for you guys to consider. I hope that has been as interesting as I hope it is. It's quite a lot of detail. It can be quite a dry subject, but it's really, really important. The Bank of England wrote out last week asking financial institutions how their systems would actually cope if the bank rate went to negative. That's telling you that they are really, really, really thinking about this. This has been muted for months now. The fact that they've gone out for a consultation means this is serious. They are seriously thinking about it. So I hope you found value in this. Please let me know if you have any questions in the comment box below. But thank you so much, guys, for paying attention. If you've not checked out the join button for my memberships, my God, there's a few people in there at the moment. It is fantastic. We've got a Discord group going on. You've got access to the investment course. I'm going to be tutoring people as in a group through the investment course. It's going to be fantastic. So make sure you check out the join button below. There are 2 options in there. But guys, if you're not also listening to the podcast, there it is right there. I appreciate your time. Thank you so much. Catch you later.